Citi's head of equity strategy Drew notes that September passed with no major hiccups. That feels better from a seasonality perspective, but it actually raises the pressure on fundamentals. To sustain this bull market, companies need to beat and raise, not just post good Q3 numbers, but also provide forward-looking commentary into 2026 and highlight structural op- structural opportunities. Without that, seasonal strength alone will not be enough. The focus is on productivity and margins. Margin expansion into next year looks almost like a given, but productivity, things like asset turnover and efficiency, needs to remain really high. If companies can push return on equity to new highs, then valuations can stay above average. That way, earnings drives the boat, and this rally becomes a healthier lag in the bull market rather than pure speculation. Cyclicals are already showing signs of strength under the surface. CSX and other names are outperforming, which signals a broadening of participation. By 2026, we should see convergence with more companies contributing to positive earnings growth. That sets up a healthier upside since the rally becomes broader and more balanced rather than narrowly led by a handful of tech giants. Consumer discretionary is one area worth noting. Expectations there are very low, but if tailwinds from lower interest rates arrive, that part of the cyclical trade can kick in. Pair it with financials, which are holding in, and the secular tech story, and you get a barbell trade. Growth on one side and cyclical beta on the other. There is a compelling way to position portfolios for broadening. Small caps also fit into this picture. They have leaned heavily on Fed rate cut hopes, but if the economy holds stronger than expected, they may not need as many cuts to perform well. From a thousand-mile view, the setup may be to own the Nasdaq on one side and the Russell 2000 on the other. Large cap value looks attractive in comparison and could be used as funding for the barbell trade. Finally, credit, credit spreads are running hot, but the macro backdrop remains constructive with little volatility in commodities, rates, or FX. Conditions are supported for risk assets, and equities are reflecting that. As long as earnings deliver and productivity stays high, this bull market has healthy lags behind with broadening upside into 2026.